Backed by the nation's trusted bank, SBI, the banker to every Indian.
As banks have been earning record profits, it is only fair that the top management takes home bonuses and higher salaries. A Business Standard analysis found that Kaizad Barucha, executive director at HDFC Bank, was the highest paid executive with a remuneration of 10.64 crore rupees in FY22. Amitabh Chaudhary, MD and CEO of Axis Bank, earned 7.62 crore rupees, and Shashidhar Jagdishan, HDFC Bank's MD and CEO, was the fifth on the list with a remuneration of 6.51 crore rupees. Good morning, my name is Ishan Gera and I welcome you to the Business Standard Banking Show. In today's episode, we will highlight the new digital lending norms released by the central bank and PM Modi's statement on India leading the world in real-time digital payments. We have an interview lined up with Vibha Padalkar, MD and CEO of HDFC Life. The Banking for You section explains what happens when a bank is liquidated. Our banking expert Tamal Bandyopadhyay tracks the history of the banking sector and discusses the problems consumers face. At the end of the show, we'll discuss the responses from the poll last week and ask you the question for this week. So stay tuned. First, here's a look at the banking developments of the week. After complaints from state governments about harassment of customers, the central bank announced digital lending norms last week. The latest regulations are based on recommendation from its working group on digital lending, including lending through online platforms and mobile apps, constituted last January. The new norms stipulate that all loan dispersals and repayments are to be executed directly between the borrower's bank accounts and the entity, eliminating the presence of a nodal pass-through or a pool account of the loan service provider. Additionally, lenders will have to present all details of fees and charges in a standardized contract and would need to follow data privacy norms in accordance with the RBI rules. Consent and transparency have been made the cornerstone of the new regulations. While RBI is taking steps to regulate digital lending, digital payments are gaining traction. Prime Minister Narendra Modi said in his Independence Day speech that India leads the world in real-time digital payments. Quote, "Today, 40% of real-time digital financial transactions in the world are happening in my country. India has shown innovation prowess to the world." Unquote. The Prime Minister said UPI has been clocking over 10 trillion rupees worth of transactions every month and volumes have surged to 6.28 billion. The banking sector in the country is also changing. HDFC and HDFC Bank announced a merger earlier this year to turn the new enterprise into India's second largest banking entity. Last week, the merger secured a nod from the Competition Commission of India. RBI had cleared the merger in July. The entities will still have to comply with RBI regulations and norms on lending and capital requirements. A 1.4 percentage point increase in the repo rate has not deterred borrowers as credit growth in the economy is picking up. Non-food credit for the fortnight ending July 29th jumped 15.1% compared to a year-ago period. The pickup in credit and improvement in bank performance are helping bring down the ratio of non-performing assets. For the first quarter, gross NPAs are down to 5.7% as per Bank of Baroda research. As rates are expected to rise further, it remains to be seen if the momentum will continue. A failure on the part of MSMEs can trigger the system. While the performance of the banking sector has been stellar, the life insurance business is not far behind. HDFC Life's net profit rose 21% in the first quarter of 2022-23. In a conversation with Business Standard Subrata Panda, Vibha Padalkar, MD and CEO of HDFC Life, talks about the company's growth and future outlook.
HDFC Life reported a net profit of ₹365 crores in the April-June quarter of FY23, up 21% year-on-year because of normalization of the backbook surplus of the company and lower operational expenses. In the year-ago period, it had reported a net profit of ₹302 crores. Its value of new business increased by 25% to ₹510 crores during this period, and annualized premium equivalent grew 22% to ₹1,904 crores. VNB margins of the company stood at 26.8%, up 60 basis points from the year-ago period. To talk more about the company's performance and the industry in general, we have with us Ms. Vibha Padalkar, MD and CEO of HDFC Life. Welcome to the Business Standard Banking Show, ma'am.
Thank you so much, Subrata.
Ma'am, I'd like to ask you about the margins. Margins for this quarter was 26.8%. What is driving the margin growth, and what is the target for margin growth for this financial year?
So at HDFC Life, Subrata, we've been consistently talking about smooth upward curve, whether it's in margins, whether it is in VNB growth, whether it's in top line and so on. And there's not been a single year wherein we've gone up or gone down. It's been consistently smooth upward curve. And that's what you see here. Well, there has been an expansion, like you say, of the margin to 26.8% against a fairly volatile environment, you'll agree. And the source of this has been a combination of growth in our overall top line, close to 20% growth, better product mix, as well as growth in and rebounding of credit life, which also was not doing too well in the thick of the pandemic. So it was a combination of all of this. Also, what's important is the savings business itself continued to grow well. So all of that put together led to this margin expansion.
Protection AP recorded a decent growth aided by the credit life business, but retail protection is lagging. Any reason behind that? Also, is this an industry-wide phenomenon or just the company is facing this problem?
No, it's very much in line with our peers in the industry. And give or take, everyone has degrown except one, and there are some nuances there. From an outside in, what it appears like is that at the midst of the pandemic, there was a very acute need in terms of protecting oneself, and so that created a demand. And like the sector, we also saw very brisk growth in retail protection. However, now given some of the headwinds in terms of inflation, some of the volatility one is seeing, supply side constraints, and so on, perhaps in the basket of goods, people are postponing decisions right now. They're perceiving it to be somewhat optional, or it can wait a quarter or so until things ease on their wallet. It's a little bit unfortunate, but that's why we do have outreach programs to say that this is not the time for us to procrastinate it. The sooner one locks in and so on, the better it is, especially at younger lives. And insurer cannot reprice no matter what. What is good is that the Google trends indicate, while they are lower, but within the Google trends, we continue to be among the top searched companies. So relatively, we are better off in terms of search trends. However, overall Google trends have gone down versus, say, the last year or a year before. But I am reasonably hopeful that this is a temporary phenomenon, that people will start rethinking about their risk transfer strategy to protect themselves and their loved ones. Like I mentioned earlier, what is good is that the credit life has close to doubled. Also, for example, our market share in protection at HDFC Bank has been steady. So some of these indicators have led to the fact that on overall protection, our the growth has increased from about 15.7% to 16.9%, just short of 17% in quarter one. So this has been fairly good. Sorry, just to clarify, not the, I think I mentioned growth. It is the percentage contribution. Growth has been about 31%. So it has been a mixed bag. To summarize, credit life has been very good. Retail has lagged, but I do think that in H2, retail should bounce back.
Some of the supply side constraints that we saw during the pandemic, have those eased from the company's perspective?
I think it's a question of a combination. Prices have gone up because of reinsurer prices, and reinsurers do provide the supply in a way for us against which to write business. However, some things have been relaxed. For example, at HDFC Life, we are looking at and have rolled out, in fact, an automated underwriting engine for financial underwriting. We're also looking at how can we take EPFO data, how can we take tax information, traces data, tax filing, so that we are paying the customer a lot less, and we are building our own analytics to figure out what is the profile of the customer, so that A, we can pay them lesser, B, we give a straight to decision very quickly thereafter based on various data points that are there. Also, we have done, like the industry, also a lot more of video medicals. We're looking at scheduling medicals at home. We had a recent breakthrough in terms of cardiac risk assessment, wherein earlier people had to go to a medical center to get their stress test done. Now we have the first life insurer wherein our technician can go to a person's home, and we have the wherewithal to be able to assess the cardiac parameters, and this has been accepted by our reinsurers as well. So all of this means that we are trying to differentiate between various profiles, what profiles we are okay to keep on our books, what profile unfortunately we have to reject because the pricing doesn't cover for that mortality risk, and third is what can we reinsure. So it's a combination of all of this that is evolving very quickly. Intention definitely is to write more and more protection within the parameters of risk that we understand.
What is the ideal product mix you're looking at, given ULIPs have suffered because of market volatility, retail production is also lagging, and there could be potential pressure on guaranteed products because of the rising FD rates. So what is the ideal product for the company?
So we've always been very, very focused on balanced product mix. It is, as far as I can remember, last decade, it has been a core stated strategy for us. Balanced distribution and balanced product mix. So it's not very difficult for us to stay about one third, if I were to put it very simply. So give or take, non-par savings is about a third, give or take participation is about a third, everything else is a third, out of which unit linked is about 25%, and balance is split between retail protection and annuity. This I'm talking as a percentage of retail business, leaving out the credit life or group business. Also, what is fairly heartening is that every new product launch that we have done and innovation has been very well accepted by the market. Actually, the prevailing high interest rate scenario augurs well for us because demand does harden. And so for us to ride on the wave of this higher interest rate scenario, at least over the near to medium term, is something that we are very well poised for.
The last 2 years were marked by the pandemic, but FY23, we didn't see any restrictions being imposed so far. So will the company be more aggressive in terms of acquiring a business and look to consolidate the market share?
Absolutely. And over the past 4 years, just before the pandemic, and we have shown a stellar improvement in market share. Yes, there might be some ups and downs quarter here or so, but overall, if you were to look at when we ended FY22, our 2-year CAGR was 17%, which was more than double the industry growth. And that's something that we have been consistently delivering. We also have delivered in this quarter growth of 20%, like I mentioned, and a market share just shy of 15%. This is on the individual APE. If you were to look at, including credit life, we are amongst the top 2 in the private sector in the credit life, and that positioning continues to be there even on the individual space. We are looking very closely on the geopolitical situation, interest rate movements, COVID, whether it's recurring in terms of mortality rates, and putting all of that together, that forms the bedrock of how we launch products, how we conceptualize products. Lifestyle stage products such as annuity and protection are somewhat insulated from these ups and downs that I just mentioned. So we're also focusing that we talked about retail protection, but equally important is the annuity business and other retiral products. Again, defy the normal trends because of inflation or market movement, because this is for one's golden years, and usually people don't want to not contribute or tinker with their nest egg, if you like. So there's a lot more of consistency in the minds of people towards wealth accumulation for their own old age. Last point is now the mortality experience is very normal, back to our pre-pandemic levels, and also is taking that extreme level of high alert because we as an industry we were hit by very elevated levels of claims. That has now receded in terms of, and because of that we're able to innovate a lot more. So it will be a push and pull on market share. As a large listed entity, we continue to triangulate top line growth, bottom line growth, as well as risk on our balance sheet.
The regulator has given some indicative growth targets to the life companies. These are quite steep targets. So, how feasible are these targets when you look at your company? And will it not lead to more mis-selling?
So, overall, we welcome that the regulator is talking about developing the sector. This is very, very important. It's like signaling that all of you can do better. And sure, we can, because if we look at overall penetration, protection gap, and all the metrics that we all know about, this is just the tip of the iceberg. So we need to be cajoled and prodded to aspire for more aggressive targets. At the same time, we will have to be responsible in terms of absolutely what you said, mis-selling. Because if you press the pedal too hard without the right checks and balances, for example, a pre-issuance verification call, for example, ensuring that the individual has given his SIECS mandate, because that means he shows the intention of wanting to pay premiums down the line. For example, explaining terms and conditions to the individual. Say an individual buys a annuity product or a retirement, that there will be X percentage, say 40% compulsory annuitization and so on. You explain that to the policyholder, or they buy a unit-linked product and on market volatility. Yes, that is very important. And like I said earlier, we need to balance our growth targets with the possibility of mis-selling, possibility of low persistency rate, and very dangerously, not holding too much risk on the balance sheet, because that will always be very, could come back and bite a company, especially a smaller company. So yes, while we are very excited about directionally the regulator being very focused on it, it has to be triangulated with all these other aspects also.
There are a number of steps that the regulator has taken in the last few months to ease the regulatory burden, so to say. How do you look at these measures, and what more needs to be done in your assessment?
The way I see it is that what has been rolled out so far, which is user file, has been phenomenal. It's been first of its kind. Also, some of the rationalization, whether it is in terms of regulatory returns, ease of doing business, as well as relaxation on requirements for PMJJBY, that has already been rolled out. A couple of exposure drafts have been rolled out as well, whether it is in open architecture, whether it's in expenses of management, some investment guidance, and so on. So there is a continuous dialogue with the regulator, which we welcome. A lot of access now has been given between the insurance companies and the regulator, which we absolutely welcome. Also, committees were formed, and 8 committees and 8 reports have been submitted on varying topics, whether it is development and penetration, which I chaired, to regulatory changes, to all other aspects on reinsurance, for example, and so on. So again, what the regulator does with all those recommendations starts becoming very critical. Our ask has also been a couple of things. Health indemnity is a long pending ask. A report was submitted over 18 months ago, and we haven't heard back. And typically, worldwide, health sits closer with life insurance companies than with motor insurance companies. So those things are there in terms of us awaiting. Also, can we distribute each other's products that are regulated? Regulator. If banks can distribute, why can't insurance companies distribute and collect a toll gate for it? Of course, with all the checks and balances that today banks go through. So, for example, why can't I distribute, say, health products that are designed by a standalone health insurance or even motor insurance and vice versa? Why can't I distribute pension products of PFRDA and vice versa? The intention is that for all of us manufacturers to be available to where the customers are through varied distributors, and that's where the touch points have to be increased, and it should be sweated out a lot more, so that you are in connect with the customer wherever the customer wants to engage with you.
That's all the questions I had for you. Thank you for taking time to come to our show. Thanks a lot.
Thank you so much, Subrata.
Padalkar says the company has been talking about smooth upward growth in margins and top line. Meanwhile, as HDFC is charting its growth story, some cooperative banks are struggling to stay in the business. Last week, the RBI cancelled the license of Pune's Rupee Cooperative Bank. In our Banking for You section, our experts explain what happens when a bank is liquidated.
Over the last couple of years, the Indian banking sector has witnessed several episodes of banks going through financial upheaval to the point where depositors have been faced with the prospect of losing their savings. However, the Reserve Bank of India has ensured that matters do not go so far as commercial banks are concerned. From superseding the board of the beleaguered Yes Bank, a domestic private bank, in 2020 and organizing a bailout by SBI, the Indian banking regulator has ensured that depositor interest is protected to the greatest extent possible. Another instance of the RBI stepping in to prevent depositor losses was the central bank's decision in October 2020 to take over the similarly crisis-hit Lakshmi Vilas Bank and push through a merger with the Indian unit of Singapore's TBS Bank. While investors may have suffered losses, as was the case with the holders of Yes Bank's AT1 bonds, the RBI has clearly sought to prevent a widespread loss of deposits. In the case of cooperative banks, the regulator has made it very clear that it will not tolerate risk to depositor interest, especially after the debacle of the Punjab and Maharashtra Cooperative Bank. In the case of PMC Bank, however, while depositors who had parked up to 5 lakh rupees would be covered by the Deposit Insurance and Credit Guarantee Corporation, those with a higher quantum would have to wait for 10 years to recover their savings and lose out on interest. In September 2021, the DICGC said that it had decided to pay depositors of 21 stressed cooperative banks a sum of 5 lakh rupees within 90 days. Over the last 2 months, the RBI has ordered the shutdown of 2 cooperative banks, the Karnataka-based Millat Cooperative Bank and the Maharashtra-based Rupee Cooperative Bank, citing a lack of sufficient capital. In both cases, the RBI said that the banks would be wound up and a liquidator appointed. Depositors of both Millat Cooperative Bank and Rupee Cooperative Bank would receive the full amount of their deposits from the DICGC, the RBI said. Earlier this month, the centre said the DICGC, wholly owned by the RBI, has ensured 49% of accessible deposits out of total bank deposits of 165 trillion rupees. From February 2020 onwards, the DICGC raised the insurance cover limit for depositors in insured banks to 5 lakh rupees from the earlier level of 1 lakh rupees per depositor.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Over the last 2 months, the RBI has ordered the shutdown of 2 cooperative banks, the Karnataka-based Millat Cooperative Bank and the Maharashtra-based Rupee Cooperative Bank, citing a lack of sufficient capital. Consumers, meanwhile, have to face many more problems from the banks. Our banking expert, Tamal Bandyopadhyay, tracks the history of banking in India, discusses the issues the consumers face and possible solutions and reforms. Hi Tamal, thanks for coming on the show again.
Thank you.
You've touched a raw nerve this time around with your column. You've given examples of harassment by bank officials. I have one question regarding that. Why is it happening now?
No, it's not happening now. It's been all along there. And I think what has contributed to this, Ishan, is the concept of branch banking has changed because of technology. Everything like credit appraisal and KYC requirement, who to give credit, how much to give credit, everything is done in the back office. So the branches have become a sales office. And these guys are under pressure. There are 2 types of pressure. One is this, the cross-selling, because if you look at the bank balance sheet every quarter when they announces the result, the kind of fee income they have. They call it other income. Other income has 2 components. One is treasury income and one is the so-called fee income. So the higher the fee income, smarter the bank. So that fee income goads you to sell stuff, which many a time is exactly not appropriate. Like one example I set up, one gentleman was sold some 9 insurance policies worth 11 lakh plus premium every year, and these are sold for his grandchildren who were in US. The insurance entity says no, they are not valid. If anything happens, they will not get it done. So the relationship manager who this gentleman trusted blindly took advantage of that. And he must have got a good raise and bonus, etc. But he raised the fee income. So that's one. And second part is the target. You have certain targets, right? Now, quarterly, your deposits have to be this much, your credit has to be this much, etc. So one example was there. Despite everything is in place, they release the savings bank account to the nominee, but not the FD, because FD was a hefty amount, and that was March end. They couldn't afford to release that money, so then that particular branch's deposit liability will come down. So they released it, but they did it in the second week of April. Now, what happened to the hapless customer? That's a state account. This lady had to wait for 1 full year.
Got your point. Now, how well has the banking ombudsman performed in such cases? Is there a need to reform that system, you think?
I don't know. I think the banks need to reform themselves. Banking ombudsman, if you see the number of incidents every year has been growing, and I would say it's a pretty efficient system. Recently I came across, there was a controversy with the public sector, with a large public sector bank, and banking's ombudsman settled it within 3 weeks. The money actually left somebody's account. The bank disowned it, and this gentleman approached the bank. It did not happen. Then he approached the ombudsman. Within 3 weeks, ombudsman settled it. It was 50-50, because the gentleman also had some, had to share some blame. Apparently, he shared the OTP with somebody. So it is not an inefficient system, but the banks need to do some soul searching. It's a very repressive financial system we have, because as I said, the credit to GDP ratio is so low, and everybody is not banked. So they take advantage of that. The banks are not sensitive. One of the way, I think today, if some bank has an USP, that customer service, it will do wonderfully well than others. And this is sector agnostic. This apathy to customers, exploiting the customers, taking advantage of the customer's ignorance, not showing the fine print, not explaining the fine print. This is across the sector. As one example I gave, one person had an FD and he was forced to open a savings bank account as well. And that apparently the savings bank account had that some minimum balance you need to have.
Yeah.
And when the FD matured, there's no interest. Actually, FD shrunk. And to his horror, the gentleman found that from his FD, every quarter the money flowed in the form of penalty. And he was never ever informed, either through SMS or through mail. So that's the multiple ways banks take advantage of the ignorance of customers.
Another area of complaint, and this has been a big area, has been the digital lending apps. RBI recently released rules in this regard. What do you make of that?
Well, it's a long discussion, but to cut a long story short, what RBI has made it clear to stop the misuse of that digital lending is that one leg has to be a regulated entity. So the responsibility lies with that regulated entity. That's very clear. If you are a non-bank, if you are neither a bank nor an NBFC, not regulated by RBI, you are in the space. But then you have to have a link with a bank. So the bank is responsible if anything goes wrong. There have been multiple cases of frauds, etc. So to stop that, one key takeaway from that, you can't be in digital business in isolation. One leg has to be with a regulated entity.
Got your point. Now, this week's column was interesting because it was written just before the Independence Day, right? And you talk about the history of banking, and then you talk about people falling outside the formal banking network and millions being unbanked. Now, one of the ideas with public sector banks was to take the banking to these people. Now, what more can be done to address these problems? Is branch opening a solution, or should we strengthen the banking correspondent network?
No, PMJDY is a great success, which the current government has launched. And this has actually changed the scenario dramatically. More and more people have come under the under the fold of banking, and all those government goodies, etc., now flow through the banks. So that's a good thing that happened. But despite that, I quoted a recent World Bank report which says that India is one of the few countries which owns a large segment of unbanked. So which essentially boils down to that we need more banks. Certainly we need more banks, which is why RBI has done on-tap SFBs and universal banks, both are on-tap. It's another matter, there is not a single bank has come up. If you see historically, we got 10 banks in 1994, all of them did not survive. Then in 2004, we got two banks, which one of them got into trouble, Yes Bank. And then finally 2015, we got 2 more banks. So if you see, since economic liberalization, how many banks have come? Just 14 banks, and all of them not survived. Of course, then there are payments bank, and there are small finance banks, and there are local area banks, so on and so forth. But we need more banks, period. And we need also to reach out. I think, as you rightly said, that BC model, business correspondent model, is one way of doing it, because thanks to digital, the kind of stride we have made in the digital world, it's much easier than what it was now. So I think we are moving to that direction, but still it's quite a distance away from that.
So have PSPs failed their mandate of reaching to every customer?
Not exactly. If you see that the very fact that 1969, the first phase of nationalization happened, and subsequently yet another phase. So they have done their job. Certainly they have done their job, but it's too much to expect from them. If you talk to any public sector banks, they will get into a nostalgia trip that we have built bridges, we have built roads, we have reached out to people, so on and so forth. And it's very true. But the fact is, you can't have the cake and eat it too. I mean, either you treat them as a business entity, or you treat them as a socio-economic vehicle for socio-economic upliftment. So we are confused on that. They are listed entities. We want them to take care of their balance sheets, the ROA and ROE, how their growth. At the same time, we want them to do everything else, which the private banks do not do. Look at the PMJDY numbers. The public sector banks are far ahead. Even during the COVID, the government scheme where the money was given with a government guarantee. Again, look at the number. Public sector banks are far ahead. So it will be unfair to say that public sector banks have not fulfilled their mission, but I think they are suffering from an identity crisis. Are they business entities, or are they a vehicle for socio-economic changes?
Got your point. Thank you. Thanks a lot for your time this week. We hope to see you next week. Thanks again.
Thanks.
Kamal points out that even though the branch managers have come out of their glass cabins and the seller's market has transformed into a buyer's market, there's no end to the harassment of customers. Last week, following the RBI policy, we asked you whether RBI should be more aggressive with rate hikes to tackle inflation. We have received a phenomenal response, and thank you for your participation. Nearly 2/3 of our respondents believed RBI needs to raise the repo rate even higher. For this week, we want your opinion on digital lending apps. Do you think the government action on digital lending apps has been sufficient? You can answer on Twitter, Telegram, or our website. We'll be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.